Hi, I'm Joshua Kirkpatrick, and welcome to Penn State Barron's series on financial literacy. Today, we'll be discussing dividends and dividend investing. Now let's start with the concept of dividends. Essentially, invest your money, give the process some time, and reap the rewards. Dividends, more like cash rewards. So what exactly is a dividend? Well, you, as an investor, can give your money, also referred to capital, to a business through buying shares of stock. The company will then take that capital and produce whatever good or service they provide in order to generate a profit. Following that, once they generated the profit, they'll take some of the excess cash and give it back to the investors through the form of dividends. Dividends work on a per-share basis, and they're typically used to show off the financial strength of the company as well as show appreciation to the investors. So let's take an example. Let's say a company has $10 million in excess cash. Now, let's say that 100 million of their shares is owned by investors. Therefore, whenever they go to pay out a dividend, it would be 10 cents per share. Now, what is a dividend yield? Well, it's fairly simple. First, you should know the higher the dividend yield, the better of a bargain you'll be receiving. So the dividend yield is calculated as the dividend paid per share divided by the current share price. Now let's look at an example. Let's say company A has been paying out a dividend of 50 cents per share. And let's say that their stock price right now is at $5 per share. So dividing 50 cents by $5, you'll be looking at a 10% dividend yield. Now let's go back to the year 1602 to really capture the history of dividends and dividend yields. So in 1602, the Dutch East India Company started paying out dividends. Now, their dividend yield was about 18%, which is almost unheard of in today's world. Right now, the S&P 500's average is at 2%. But let's look at a more modern example. Take Blockbuster, for example. Whenever they were still in business in 2005, their dividend yield was at 0.2%. So 18% to 0.2%, that's come a long way. It really goes to show how dividends have changed over time and as well have dividend yields. Now, let's look at dividend operation and selection. Do all companies pay dividends? Well, the short answer is no, they don't. No matter if a company is public or private, none are legally required to pay a dividend. And if you look at the graph on the bottom left-hand side, you can see that there's only so much of dividend-paying stocks out in the market, and even smaller of a fraction of companies that are known as dividend aristocrats, or companies who have been paying dividends that haven't decreased or have increased over time. Now, how does a company decide to pay a dividend? Well, the most important choice for the company is either to pay the dividend or to reinvest the money. And if they reinvest the money, there'll be no dividend to be paid. However, if they decide to pay a dividend, then they'll be faced with a few crucial decisions. Number one, how to pay. Number two, when to pay. Number three, how much of a dividend to pay. And number four, how often to pay the dividend. But when it comes to dividends, the board of directors for the company in question holds all of the power. Now, why do companies pay a dividend to begin with? Well, there's two main reasons. Firstly, using shareholder money to invest in their own company shows that the shareholders have been loyal to the company, and therefore, the company would like to extend its appreciation to its shareholders to make sure that moving into the future, shareholders maintain that loyalty. And on the other hand, it's also a financial indicator. Healthy dividends equal business is great and we're making money. Now, let's look at why dividends are so important to investors. Let's look at 4 prime examples. First, dividends can be used as potential financial indicators. Essentially, if a company reduces their dividend, then the investors will see that they are no longer able or confident enough to pay out the same dividend that they had been paying. Number 2, it acts as a stream of income. For most companies, they pay dividends quite consistently, at the same times, at the same frequencies. So investors can essentially use it as a stream of income to pad their already growing investments. Third, it acts as a form of preservation of their money. Dividends help grow your overall investment portfolio. Lastly, it helps mitigate overall portfolio risk. By adding in companies that pay dividends, they're more likely to be stable. And while they may not grow exponentially, the dividends being paid into your investment fund help diversify and protect the overall portfolio. Now, dividends can be great, but you should be aware of some potential downsides. And it's important to remember, past results are no guarantee of future performance. Some of these potential risks are falling share prices. Once a company pays a dividend, that dividend will come directly out of their stock price, meaning it will drop. Then, less price appreciation. Recall how I mentioned earlier that dividend-paying stocks don't usually grow as much as their non-dividend paying counterparts. And as such, you're less likely to see price appreciation coming from those stocks relative to those who don't pay dividends. And lastly, dividend elimination. At any point in time, a company could simply eliminate or reduce the dividend that they're paying without warning. And just some food for thought, typically dividend stocks are less risky than non-dividend stocks, but understanding the risks will help you make informed decisions. Now, you may be asking yourself, how can I receive dividends? Well, it's 3 easy steps. First, find a dividend-paying company. Then, purchase a stock before the ex-dividend date. Then, lastly, hold the investment until it pays a dividend. Now, there's 4 important dates that you should be aware of. First, the declaration day. This is the date that the board of directors of a company says, hey, we're going to be paying a dividend. Next, the ex-dividend date, which is essentially the date for new shareholders that disqualifies them from earning a dividend. Next, the date of record. This is the date that the company goes through the shareholders and decides who qualifies for a dividend and who doesn't. Then lastly, the payable date. This is the date that the company actually declares that they're going to be paying the dividends out and go through with it. Now, you also may be asking yourself, why wouldn't a company pay a high dividend? Well, most investors want a short-term reward through the form of dividends, while they also want a possible long-term return on their investment within the company. So, it's a delicate balancing act. Now, if a company does pay a high dividend, then they'll be sacrificing the possibility of a long-term return for a short-term reward. Now let's move to dividend investing. First, something to remember, the dividend rule. Before retirement, reinvest dividends. After retirement, use the money to live. Now let's look at dividends in action. Let's say Dan just graduated from school and started his first job at the age of 20. By saving $3 per day, he's able to invest in stocks paying dividends. Once he gets a dividend, he reinvests the money to be safe in hopes that it'll be worth it. And he starts with an initial balance of $5,950. As we continue with the example, as years fly by, Dan is already 40 and wants to check on his investments. Fortunately, his choice to reinvest the dividends he received has paid off. Now let's look at two scenarios to explain. In the first scenarios, he only invests $3 a day into his Roth IRA, but he doesn't reinvest the dividends. Well, at the age of 40, his investment is worth $118,458. Whereas on the other hand, within the second scenario, by reinvesting his dividends as well as investing the $3 per day, his ending value at the age of 40 is $149,194. There's a big difference between not investing the dividends that you receive and reinvesting the dividends that you have received. Now let's look at some high dividend yield companies. Although only a few companies pay a dividend over 10%, it's still a good idea to search for them. Now remember, the S&P 500's average is at 2%. However, looking in the bottom left-hand corner, there's a couple of different companies that pay over 10%. So let's take the first one. Let's say that the Shell Midstream stock is subjected to the actual dividend yield versus the S&P 500's dividend yield. And if you go through and pay out the annual dividends using both dividend yields, you'll notice at the very bottom of the table on the right-hand side, where it states total dividends, there's a huge difference between using Shell Midstream's actual dividend yield versus using the S&P 500's average yield. Therefore, you can see the benefit in doing quality research into finding companies that pay higher dividend yields. Now let's look at the relationship between stock price and dividend yield. Here are some tips. It's an inverse relationship. The higher the dividend yield, the more likely it will be unsustainable. Because whenever the dividend yield goes up, the stock price goes down. And whenever the stock price goes up, the dividend yield goes down. So my first tip is companies who raise their dividends without increased profits should typically be avoided. My second tip is that companies who reduce their dividends usually see a decrease in their stock price, so you should probably avoid them as well. Now let's move forward to dividend investing. What is dividend investing? Well, it simply refers to building a portfolio of stocks that pay out stable dividends and continually increase the size of their dividends. It's a long-term investment strategy with the purpose of income stream creation, and it provides steady investment returns. And there's a couple different benefits that come with dividend investing. For example, it forms a stream of income that eventually replaces a salary. During retirement, you can rely on a stream of dividend income to replace your salary for whenever you're no longer working. As well, you can enjoy the compound interest effect, which will greatly boost your overall investment. Companies who pay dividends are usually less volatile and more defensive. As well, dividend payments are fairly predictable and are paid at consistent dates. Lastly, payments offset potential losses from stock depreciation or inflation. Now, let's talk about DRIP, or dividend reinvestment plans. It simply refers to an investment plan where cash dividends are reinvested to purchase more stock in the company. The technique uses dollar cost average methods, which are intended to average out the price that each share is bought at. And these are unique plans. The dripping of investments is open to fractional shares. Now let's take an example. Bill's Sports Inc. pays a $10 dividend on a stock that trades at $100 per share. Under a DRIP plan, each investor would receive a tenth of a share after every dividend payment. Now, if you're interested in learning more about dividends, you can use the links provided on the screen above. Thank you for joining me for today's presentation on dividends and dividend investing. Have a nice day.